welcome to the show.
All right. It's been another big week. Surprise.
Yeah. We're doing this on Friday. You guys are listening to it on Sunday. And, all kinds of crazy Fed info just came out right before we're starting to record the show, which we kind of expected. So here we are.
It's 11:30 in the morning, so who knows what's going to happen by the end of the day. But the Fed was out in Jackson Hole, Wyoming for the week, doing their annual symposium of the people that actually run the world.
Yeah. Can't they do that over a Zoom call? Why do they all get to go out to Jackson, Wyoming? I want to go to Jackson, Wyoming.
They go to cool places.
They do, as they should. If you're going to do it, you might as well do it nice.
I mean, if you're running the world, I guess you get to go where you want to go.
I guarantee you, if it was our outfit and we were working for the government, they'd make us do a Zoom call.
Yeah, probably. These days and age, yeah. So big speech this morning from Jay Powell at the Federal Reserve. He came out and said that he is now, based on the most recent data, he is confident that inflation is on a glide path back to 2%. And so the Fed has two mandates, right? Maximum employment and stable prices. So the stable price side is inflation. So he's been, for the past 2 years, raising rates to try to get inflation back down to 2%. So now he's apparently satisfied that we're going to get down to 2%. So now he can switch gears to looking at, to doing everything he can do, was kind of the quote, to help the labor market. So the ironic thing, if you guys have been watching the show, we did a thing on the SOM rule, which triggered at the beginning of August, which basically is a measure of the acceleration of unemployment. And whenever the SOM rule triggers, it's 100% accurate. It's the beginning of a recession. So
historically, it has.
Historically,
yeah. We'll see if somehow it does it this time.
I mean, history statistics are what they are. But the unemployment rate is accelerating to the upside, and so it not probably uncoincidental. The Fed says now I'm going to shift from focusing on inflation to focusing on the deteriorating economy, basically, which is the unemployment rate going up. So we also had some pretty interesting, if you were watching the news, it's not going to come out a lot on the mainstream media, but it did come out. It was on CNN, and it's for the past, at least the past year, the revisions. So they come out with all these statistics, and unemployment rate is X, or new jobless claims this week is Y, whatever. They make those statements, and the market moves based on what those statements are. And then they come back later and revise those numbers. And they put that out, but the market never responds to the revised numbers. And so what's happened over at least the past year, the new job created number has been revised down like every time they've come out with a new job created number, a month or two later it gets revised down, and sometimes pretty significantly. So all these jobs that supposedly have been created over the past year, only about like 2/3 of them have actually been created. And so the CNN spin on that actually was like, well, that doesn't really matter because obviously the market's doing well and the economy's doing fine and unemployment's not that bad. So it's okay. Even if we screwed up the number by 30%, obviously it doesn't matter. Well, it matters because that's what the Fed is using to manage interest rates, right? That's the inputs that they get, and the numbers keep getting revised down. So the economy is not as strong as those numbers, which weren't great anyway, but the economy is not as strong as those numbers said. And so it's probably a good thing that he's now shifting from inflation to managing the labor market. So there's a lot going on. And at the same time, the stock market's going up, and it went up a lot. Well, it's the middle of the day, so who knows how the day ends. But either people are going to look at it and say, market always goes up, buy the dip, it just keeps going, or they're going to realize that, the market's going up, and that's great, be in the market when it's going up, and the risk is always there. Let's just put it that way. Okay. Podcast 25 August 2024. So we'll talk about what happened this week. Take a look at who are the bulls, who are the bears, and what's the delta between them. And you can just think. We'll give you some ideas to think about and see if it makes sense to be in the stock funds based on your personal circumstances and risk tolerance. And we'll take a look at gold, because I'm not saying you should buy gold, but I'm saying it's a really good technical analysis chart, so a learning opportunity, and then the TSP fund charts. So what happened this week? Not really any economic news on Monday, but the market rallied for whatever reason. S-Fund was up about 1%. Tuesday, we had two Fed speeches, not the Jay Powell, the Fed chairman, but two different people came out on Tuesday afternoon, but there wasn't any really significant economic data. TSP struggles throughout the day, closed down just a little bit, 0.2%. On Wednesday, the 30-year mortgage rate comes out and the mortgage application data. So the rate for the 30-year fixed mortgages dropped from 6.54 to 6.5. But at the same time, mortgage applications decreased by 10%. So rates are coming down a little bit, but also people that are looking to buy new houses, right? Mortgage applications decreased by 10%. S&P was up 0.4 for the day. Thursday is kind of what we're talking about. This latest initial jobs claim rose a little bit more than expected. It was the latest number was jobless claims, right? So people that are going claiming unemployment, 232,000 versus the forecasted 230,000. Not a huge deal. And then existing homes, so people that are trying to sell existing homes, not new home starts, but existing homes, goes up to 3.9, from 3.9 million to 3.95 million. And we get an across-the-board selling. So the C fund was, or S&P is down, 0.89% on Thursday. Okay, and then Friday, Fed chairman comes out, like we said, this annual Jackson Hole Symposium. So Powell says that recent data gives the Fed confidence that inflation is on track for 2%. So he kind of does a little victory lap about that. So what it's saying is rate cuts are coming in September. And because we got confirmation that rate cuts are coming in September, the market jumps, at least in the morning. So we'll see how it ends up for the day. And again, now the Fed is focused on stability of the labor market. So there's a lot going on. Okay, so the bulls. So we get a couple different sites here, but as of August 2024, the average year-end price target for the S&P 500 is 54.26, or 54.29, according to recent data from Bloomberg. So the median target, which is a more balanced view of expectations, is slightly higher at 5,600, which is pretty close to where we are right now. I'm sure I'll have that on a chart in a minute. So again, the average price target and then the median price target, 54 to 5,600, which is roughly where we are right now, or a little bit less, right? Because we're above 5,400. That's the high end. Several firms have updated their targets recently, reflecting optimism fueled by strong earnings, which is true, impact of AI, expectations of potential interest rate cuts by the Fed, which now we know we're going to get. So on the high end, you got Evercore ISI has the highest target at 6,000 by the end of the year. Okay, citing continued benefits of AI and the economy is doing well. Oppenheimer and Yardeni Research, Yardeni is very bullish. Their targets are 5,900 and 5,800. Okay, so the most bullish guys, most bullish analysts or researchers are 6,000, 58, 59, 6,000. Okay, those forecasts suggest a generally positive outlook for the S&P, although there's still a wide range of opinions among analysts about how the year will end. Okay, so that's what the bulls say. The most optimistic people on Wall Street have us at 6,000 for a top end for the year. How about the bears? So again, as of August, some of the lowest year-end price targets for the S&P. BCA Research is one of the most bearish. They have us down at 3,700 on the S&P by the end of the year. Okay, targets based on their expectation of a typical U.S. recession combined with significant earnings drawdown, which they believe could severely impact the S&P 500. And then Morgan Stanley, who this guy actually, I don't remember if it was him, so I shouldn't say that because that would be different from this article. There was somebody that we talked about recently that got fired for their continued bullish or bearish position, and I can't remember if it was Mike Wilson or not. But Morgan Stanley, Chief Investment Officer Mike Wilson, has a target around 3,900. Right, it's been consistently cautious, warning that tightening financial conditions, which we've had until the Fed now comes out and says they're gonna cut rates, which frees up financial conditions. But anyway, he's warning tightening financial conditions and slower economic growth could weigh heavily on the market. So these targets represent the more pessimistic outlooks on Wall Street, reflecting concerns about potential economic downturns and declining corporate earnings. Okay. So you get the bulls on the high side at 6,000. You get the bears on the low side at 3,700. So these are like the smartest guys in the room, right? They get paid a lot of money, and they sell the research to IRAs and pension funds, and that's what big institutions are using this research to make decisions about how to front load decisions and try to figure out which way the market's going to go. And that's what, not to say that's what we do, because we respond to what the price does, but that's what we're doing as TSP investors, right, is to try to be in the funds that are going to go up or down. So this is what a chart of all that looks like. The high end is 6,000. The low end is 3,700, right? This is the low from October 2022. I mean, how are you supposed to
make decisions
with that? The smartest guys in the room are couldn't be further apart. Right. So that's
worlds apart.
Yeah. That
on a percentage basis, do you have that or no?
No, I don't have it on a percentage basis, but it's the whole, all the gains that we've made, since 2023 are gone if the low end guys are correct.
And even if they're half correct, right?
Yeah. I mean, obviously they're not doing, what we read. None of this is technical analysis. It's all fundamental and macroeconomic things that they're looking at. They're not looking at what price is actually doing.
Sure.
So that's number one. They're really spread far apart. Number two, the average and the median are relatively close, right? And they're basically where we are right now. Okay, so if the average and the median, they're saying, and don't forget this is by the end of the year, right? So, and we got, this much time to go. This is a weekly chart, so we still got a little ways to go. Could we come way down and then come all the way back up? And so both of them be right? Obviously these guys would be wrong because by the end of the year they'd be wrong, but they could be right by the end of October. The thing I just wanted to kind of point out for people to kind of think about, we aren't too far. We're above the average right now. We're right on the median expected by the end of the year, and we're not that far away from the highest, most bullish guys on Wall Street. So is it reasonable to say, okay, I think I want to lock in these gains and see what happens by the end of the year? Because if you say at best, I would not get these gains. If the most bullish guys turn out to be right, I wouldn't get those gains. So this is your potential upside if you look at it that way. But your potential downside is this, if these guys are right. So from a risk-reward perspective, if you don't want to actually follow what price is actually doing, like if you looked at this in Vegas, it's a no-brainer, right? So it's something to think about. And all I want to do is put the picture up there. If the median thinks that we're going to be here by the end of the year and we're already there now, why would you want to hang out in the stock funds right now? right? It just doesn't, because your risk is all this time, and it can go this way too. But it's just for the next couple of months when we have the most contentious election cycle in the history of the United States, probably. Okay. All right, gold. So a lot of people talking about gold. They're always talking about gold. So GLD is the ticker symbol for the gold trust. A couple things I wanted to point out about this. First of all, the chart is great, right? This is a really good cup and handle pattern. You get a breakout. It's a weekly chart. You can see a big picture of it. It's very, very simple. You got a high, a retest, a retest, a retest, a retest, and then a breakout. I mean, it's an awesome chart. Where did you want to buy gold when it broke out, right? So we're going to kind of drill down on it a little bit on the next chart, but if you want to say when it gets above those wicks, anywhere in there is the time to buy it if you're a long-term gold investor, because you got a consolidation in gold from 2011 was the last top to 2024. It's this huge long-term consolidation. You had this big move up. The next move is up in gold. There's almost 0% chance that it rolls over, breaks this support level, and comes down from here. It's very unlikely. Having said that, the reason I circled this one right here, this is 2007 to 2009, right? So this is the great financial crisis. So what happens when you have a serious bear market is everything gets sold. So even though gold, the price of the S&P 500, if you looked at it, was like that, right? So gold did better as a hedge against the S&P 500, but you don't want to be in anything that's really falling, right? So if we were to get another collapse like we did in 2008, everything gets sold off, right? Gold can come back down. Maybe it finds support here, maybe it doesn't. As long as it stays above this low, this trend is still in place. But gold won't necessarily. This is important because gold will not. It'll go down like everything else. If people have to start liquidating because the market's collapsing, they sell everything. That's the point. That's the point of showing that everything gets sold in something like 2008. Okay. So if we assume we're not going to get that kind of scenario, this is the kind of the shorter term of what it looks like, right? This was the most kind of recent top, and then we kept getting this test, right? But we were getting higher lows here, right? We got this left shoulder, head, right shoulder. This is the neckline. This is definitely the week that gold exploded to the upside. And so if you missed it because you weren't looking at a chart of it, and a lot of it is just picking the handful of charts that you really want to watch and knowing when or seeing when they break out of important chart patterns. But if you put a line in the sand right there, because if it rolls over and gets below that, then it's coming back to retest. But you could be in gold right now as long as it's above that low. And it's a weekly chart, so chances are it just keeps going higher. But again, I'm not saying go buy gold. I'm saying it's a really good chart for understanding how technical analysis works. Okay, TSP fund charts. So this is the chart we put up every week. Each tick on the chart here is 1 week of price action, and the blue line is the 20-week moving average line. So if you're following on a weekly basis, as long as price is above that 20-week moving average line, you're in good shape, right? When it's below it, you don't want to be in the stock funds. When it's above it, you're in good shape. This was a huge outlier. We never got a weekly close below that 20-week moving average line, right? once we got above it back here in November 2023, we had a pullback to support there, and we had a pullback to support here. This all happened during the week. By the end of the week, because a week, if you guys remember, two or 3 weeks ago, whatever, the yen carry trade collapse debacle, we opened Monday way down. So this is where the market opened for the week, and it closed the week at the top of that green candle. And so if you looked at this on a line chart, we never got below that blue 20-week moving average line. So we never got a sell trigger on a weekly basis, right? And then the market kept going higher. So you still would have been in the C fund all the way along, right? This was definitely scary, but we never got a weekly sell trigger. S fund, nowhere near its prior high, right? That was back in 2021. But we got a long rectangular consolidation there, a breakout on that week, and now we're back in this consolidation here. And it looks like the S fund is trying to break out. And so as long as it's above this line, the S fund is in good shape. So it looks like it's going to close the week up there. We'll see how it goes, but it's very possible that the S fund keeps going higher from here, because this is a pretty long-term consolidation. So that's a positive, right? The C fund, I mean, it's very close to all-time highs, which is good, because if you get above all-time highs, it tends to keep on going. But the S fund this is a lot of potential energy built up here. And so if it breaks to the upside, it's very likely the S fund goes higher. We're gonna talk about that a little bit more in detail in the newsletter. And the I fund, we've been talking about this for a long time. You got a triple top back here in 2021. We tried to get above it a whole bunch of times in 24 and couldn't do it. It looks like, as of noon today, this candle is going to close above 82. So if we can get above 82 and stay there for a couple of weeks, now this resistance line, which has acted as resistance, should be support on the other side. So that's where you get a low-risk entry, right? If it's above that resistance level, you get in. Because if it breaks down and closes below it, because now it should be support, if it closes below it, support failed, and it's likely to continue lower. So that's kind of how you figure out the high risk reward, high reward versus low risk entries. And then the F fund, still, it's the best looking chart because it's got this long-term head and shoulders. This was a historic decline in the F fund. You got this left shoulder, head, right shoulder, and this is the neckline. You get a huge breakout through the neckline. The Fed is telling us rate cuts start in September. When rates go down, the price of bonds goes up. So everything indicates that the F fund is going to go higher. At the same time, the F fund is not the place to be if the stock funds are going higher. So the F fund is good because it's less volatile and the chart is really good. The C fund is if it makes new all-time highs, the C fund is good. The I fund is breaking through resistance at 80, 82. That's good. The S fund looks like it's breaking out to the upside. That's good. The only fund right now that is actually decreasing in value is the G fund, because as rates come down, your rate of return in the G fund goes down. So everything says basically be in the stock funds.
Right.
At the same time, you can't be in the stock funds and put your head in the sand. That's really the biggest.
Well, that's always the difference. That's what we talk about all the time. So I'm thinking, as we're looking through these charts, yep, I see a lot of opportunity, right? A lot of potential opportunity. Yep. The downside, though, is feeling all that optimism,
Yep.
going all in, and then taking your eye off the ball because you're doing, something else, right? We say this all the time on the show. Like, if you're going to actively manage your account, you have to actively manage your account.
Right.
You cannot just walk away, particularly if you are going to go all in the stock funds. Maybe right now you could make an argument to be evenly distributed across all four.
Sure.
But the bond, CS&I and F, you could make that argument easily. And there's not a lot of risk in there right now. As those start to move, and you're watching the show every week, you're going to know. As those start to move around, the risk shifts, and then you just have to keep your eye on it. You watch this show every week, you're keeping your eye on it, but you cannot just kind of, hey, they said it's a great time to be in stock funds, boom, and then miss the show for a couple of weeks or not right. Watch the charts or whatever, because this can all change very quickly.
Yeah.
And I think a lot of for what you talked about with the Bears and the Bulls is a huge reason to definitely not taking your eye off the ball now, because the Bulls aren't far from where we're at and the Bears are way far.
Right.
So the risk is actually pretty high if you believe them.
Yeah.
Right?
I mean, from my perspective, knowing the risk is the whole thing, because if the stock funds are going up, you want to be in them. At the same time, you want to know when where the line in the sand is, so that you want to maximize those gains, but you want to cut your losses short if it turns out that way. But it's like that every day. This isn't anything new. It's just that the market's really overvalued, and the economy is struggling at best. If unemployment, the bottom line is, if unemployment continues to accelerate to the upside, this whole thing rolls over. If it doesn't, the whole thing goes higher. So all you have to do is pay attention. Yeah. That's all I got.
That's all you got. Questions. If you guys have any questions, as always, you can put them in the comment section wherever you find the video. If there is no comment section, then shoot us an email. We love to get the questions. We love to get the comments, because a lot of times we use the stuff on the show.
Yep.
Because it's actually, if you're thinking that, there's probably 100 or 1,000 other people thinking that. So it's very helpful. Don't hesitate to give us the comments. Hope you guys had a great week, and hope you have a great week coming up. And we will see you next time.